Welcome to the debate. So let's open today with a paradox. One that's probably pretty familiar to, well, the most ambitious higher earners out there. It's that moment when you hit a major financial milestone. Maybe it's that 7-figure mark or a huge bonus, and you're staring at your portfolio dashboard. And yet you feel strangely unsettled. You're objectively wealthier, but it just feels like the goalpost for what wealth even is keeps moving further and further away.
Right, and that feeling, that constantly shifting target, it isn't some kind of moral failing or greed. I think it's the precise tension we need to tackle today. The core question is this: is defining your financial enough a rational, maximizing strategy that actually secures your well-being and control over your time? Or is it in fact a dangerous, premature ceiling that trades away the optionality and resilience you absolutely need in an uncertain world?
My position is that setting enough is the single most critical financial strategy you can have. It's the necessary line in the sand that turns abstract capital into a concrete life. It reduces the anxiety of that endless striving, and it forces you to ask what risks are just no longer worth taking.
And I'm going to argue that this self-imposed limit is a risky underestimation of your future needs. The real risk here isn't greed. The real risk is complacency disguised as wisdom. It's the risk of completely undershooting how long you'll live, what you'll need to spend, and the true cost of future, black swan events.
Look, defining enough is a legitimate and I'd say highly rational strategy. It's rooted in maximizing utility and controlling your time. We have just overwhelming evidence showing that the marginal utility of money diminishes exponentially. I mean, if we look at the Killingsworth and Kahneman collaboration, a really rigorous study on income and happiness, they found that for the least happy 20% of people, emotional well-being just plateaus. It flatlines around a household income of $100,000 a year. So for that group, striving for more money simply stops making them less distressed. Why keep playing a game that offers zero psychological return? And beyond that, setting this boundary is a defense against the psychological traps of, continuous striving and that insidious habit of temporal discounting.
And just to clarify, temporal discounting being the tendency to undervalue future rewards, so delaying enjoyment until your health declines.
Exactly. Enough is the defense against that. It's what allows us to convert abstract wealth into control over our most valuable, non-renewable asset, our time. It defines a boundary where we can shift our energy from production to presence. It secures what I call the memory dividends of youth. Experiences you just can't buy back later, no matter how big that final portfolio is.
Okay, I see why you're emphasizing that utility argument, especially for that most distressed group. But that data set really cuts both ways. And focusing only on that $100,000 ceiling ignores the reality for the majority of the population. Setting a fixed ceiling prematurely sacrifices the, frankly, irreplaceable power of compounding, and it exposes you to catastrophic risks, longevity and inflation being the main two. I mean, when we look at that same research, we have to acknowledge the nuance. For the majority, the middle 60%, and the happiest 20%, happiness continues to rise linearly with the logarithm of income. And for that happiest group, utility gains actually accelerate beyond $100,000, so there's a perfectly rational basis for them to keep accumulating. But beyond the psychology, the practical risk is just paramount. We're living in a world where 40, even 50-year retirements are becoming common. Our traditional financial models, they just fail to account for this. And we see that failure in the data. Older Americans express huge financial regret. Over half, 52%, regretted not saving more. 34% regretted quitting work too soon. The dominant failure in the American financial story isn't greed, it's underestimation.
That's a compelling counterpoint on the data. But let's go back to the calculus of human cost versus the next marginal dollar. The psychological cost of always striving, it just grows, increasingly prohibitive compared to the diminishing utility of the money you're accumulating. This relentless drive for more often results in highly successful people, dying on a big pile of worthless money. And they do that because behavioral biases like loss aversion and paranoia prevent them from ever actually spending their capital while they're healthy enough to enjoy it. I've seen clients who hit their number, but because they never defined a boundary, they're paralyzed by the fear of running out. They're still checking their portfolio every day, their blood pressure is still high, and they miss the chance to reclaim their time. Setting a boundary is essential because it protects your health, your relationships, your very presence from the strain of that perpetual chase.
We're trading marginal dollars for concrete well-being now.
I understand the behavioral paralysis you're describing. I do. But I have to challenge the premise that the marginal value of income diminishes. You're right, the utility of a single dollar does decline. But that mathematical reality is offset by the structure of real-world income. Real-world incomes, let's say moving from $300K a year to $600K, they vary exponentially. This exponential jump in capital inflow effectively cancels out the declining marginal value of the dollar. And that means each proportional step up the income ladder is associated with a non-diminishing increment in happiness for most people. And moreover, if you just look at the math of accumulation, the most explosive growth in a portfolio happens in its final years. That's peak compounding. Stopping at some artificial enough number right before that phase kicks in is arguably the most expensive decision you can make. You are sacrificing immense future flexibility for a bit of present psychological ease. And that's a trade that is rarely balanced over a 50-year timeline. And this leads directly into the structural risk of exiting too early and the concept of path dependence. I'm talking about the irreversibility of exit. A career exit, especially in a specialized field, is often irreversible. It's due to what academics call the hysteresis effect. Basically, your skills get stale and your professional network decays with shocking speed once you step away. Think about a specialized trader or a corporate strategist who steps out for 5 years. That edge, that critical network, it's almost impossible to rebuild to its previous peak. So, uncapped accumulation isn't greed. It's a necessary hedge against black swan events, against risks you just can't forecast. You're giving up crucial future bargaining power.
Then cancels out all those mathematical benefits. Lifestyle creep. How does uncapped accumulation protect against that? It doesn't. Defining enough is the only necessary defense mechanism. Unchecked income just leads to normalizing ever higher spending, the luxury trap. The moment that happens, your initial rational enough number suddenly needs a much bigger portfolio to sustain it, and the goalpost moves again. A structure of defined satiety with spending rules provides the discipline that just chasing more completely lacks. It sets a boundary on consumption, not just on accumulation.
Okay, so maybe we can agree that enough shouldn't be seen as some static number, but as a dynamic set of trade-offs across time and risk tolerance. However, your focus on limiting growth to control spending, it misses the dominant risk facing retirees today, which is longevity misestimation.
I would frame the need for rigor differently. Defining enough is precisely what forces that rigor. It forces you to calculate your required safe withdrawal rate, your SWR, which then dictates how much capital you truly need. This defined number is the only way to proactively fight sequence of returns risk, the danger that a market downturn right after you retire permanently wrecks your portfolio's longevity. Defining enough forces you to protect against that risk when you shift from accumulating to decumulating.
And I will counter that. The failure to set the bar high enough due to risk avoidance is far more common. We have experimental evidence that shows when you give people objective survival probabilities, their regret over financial decisions, like not annuitizing enough, jumps by 42%. This shows pretty powerfully that the common failure is setting the target too low because of what researchers call survival pessimism or just plain avoidance. The fear isn't that we'll greedily save too much. The fear is that we will be dramatically wrong about our lifespan, our health costs, and the resources we'll actually need.
So for me, at the end of the day, the essence of enough is about converting financial success into personal agency. It's about defining the boundary that allows you to reallocate your life's energy from perpetual production to immediate presence. It's prioritizing those memory dividends of youth and ensuring the pursuit of wealth doesn't consume the very life it was meant to serve.
And I maintain that the pursuit of more is often just necessary preparedness, not greed. It ensures maximum flexibility. It maintains the real option to adapt in a world where longevity and market volatility are so often exponentially underestimated. This accumulation protects against the single most dominant, documented financial regret there is: undersaving.
Which brings us to the final question, I suppose. If defining enough is supposed to buy you freedom, why do some people feel freer chasing more, embracing that optionality in the challenge, while others feel completely trapped by that exact same chase?
That is the core unresolved question every high earner has to face for themselves.
Thank you for joining us for the debate. If you appreciate sophisticated exchanges on complex financial dilemmas, please like this video and subscribe for more finance debates.